the household debt situation in Singapore remains healthy, although there is a need for prudence in borrowing as interest rates are expected to rise in the coming years. The overall debt servicing ability of households has remained manageable, with a median total debt servicing ratio, or TDSR, at 43% last year. This is well within the TDSR threshold of 55%, which was tightened last year as part of the government and MAS's property cooling measures. Second, the credit profile of mortgages is still healthy, with a proportion of delinquent mortgages at less than 1%. Third, household net wealth grew even through the pandemic, with household assets growing faster than household debt, and households' liquid assets such as cash and bank deposits continued to exceed their total liabilities in aggregate. Now, most households should be still able to service their mortgage as Singapore's domestic interest rates pick up alongside global rates from their current lows. MAS's stress tests suggest that the median household mortgage servicing ratio will remain manageable even under scenarios of significantly higher interest rates or lower incomes. However, there will still be a small segment of households with higher leverage who will be more constrained by interest rate rises. More broadly, all borrowers should exercise caution in their home purchases to avoid having to cut back on other household expenditures if interest rates rise sharply. Now, this financial resilience of households to service their mortgages reflects the effects of measures that MAS has put in place over the years. The interest rate used to calculate loan repayments under the TDSR is the higher of 3.5% or the prevailing market rate. This rate is about 2 percentage points higher than prevailing interest rates for new private property loans, which builds in a buffer for borrowers to service their mortgages across a normal interest rate cycle. Now, loan-to-value limits and restrictions on loan tenure have also encouraged greater financial prudence among mortgage borrowers of different profiles. For example, loan tenure restriction limits the duration and hence the overall financing that older borrowers can take up, because it is likely that income sources to support mortgage repayment will be more constrained after retirement. MAS also requires that financial institutions provide home buyers with the information they need to make sound and prudent decisions before extending them residential mortgages. This includes projections on how a borrower's monthly mortgage installments would vary under different interest rate scenarios. MoneySense, our national financial education program, also alerts consumers to important financial considerations when committing to a property purchase, including the recurrent long-term costs involved.
And where's Alvin Tan? You're taking both 17 and 18 together. Would that be correct?
Yes, that's right. That's correct.
Mr. Saktiandi, Supaat.
Mr. Speaker, I'd like to ask two SQs. First is in regards to what MAS mentioned just now about the TDSR being in a good condition. I'm sorry about that. Mr. Speaker, I'd like to say that it's good to hear that the TDSR is in good condition. But may I ask what is the proportion of the segment of those exposed in the population in terms of personal unsecured lending, unsecured loans? Second SQ is regards to domestic interest rate outlook. The Federal Reserve Bank of US actually is expected to raise their rates quite significantly. I mean, the expectations based on their committee's announcements, there will be sharp rate hikes over the course of the year and into 2023. Given that it would definitely affect the domestic rate situation in Singapore, and it will be very fast. It will definitely affect households and businesses in terms of cash outlay, especially so in current inflation environment that we're seeing now. So can MAS share what's our domestic rate outlook? And I think he mentioned just now about the projections and scenarios, but what does it mean for households and businesses in terms of the rapid pace? Thank you, MAS.
So I thank the member for his questions. As the honourable member would know, the outlook for Singapore's domestic interest rates are closely tied to global rates. Accordingly, households and businesses should expect a pickup in domestic rates and its attendant increase in financing costs. Now, most Singapore-listed firms continue to hold sufficient liquidity in Q4 2021, with liquid assets such as cash and cash equivalents continuing to exceed their shorter-term liabilities. And the debt servicing of Singapore-listed firms remain manageable, with most firms having sufficient earnings to cover their interest expenses, even in prescribed stress scenarios or further increases in interest rates, with cash reserves providing additional buffers in this regard. That said, the highly leveraged companies, especially those with low net profit margins, may find the increase in borrowing costs eroding their cash flow. This would also apply to some of the SMEs which continue to underperform due to COVID restrictions. But the broader economic recovery should provide some reprieve as Singapore opens up and emerges from the pandemic. To the members' questions about personal unsecured lending, now credit quality has remained generally favorable and stable over the past year, having improved from pre-pandemic levels. As a share of GDP, outstanding credit card balances have come down from 2.5% in Q4 2019 to 2.1% in Q4 2021. Similarly, rollover balances as a share of GDP have inched down from 1.3% in Q4 2019 to 1% in Q4 2021, and the charge-off rate decreased further from 6.3% in Q4 2019 to 4.4% in Q4 2021. In all this regard, we urge consumers to be prudent with their new borrowings to reduce vulnerability to further income shocks in a higher interest rate environment. I'd like to also assure the member that MAS has also helped consumers who need assistance with their outstanding debt. For example, consumers in financial distress can seek help from the Credit Counselling Singapore for debt management assistance, or by taking out commercial products such as debt consolidation plans that may alleviate their repayment burden. Thank you.
Mr. Desmond Choo.
Mr. Speaker, would the MES consider, especially for first-time young buyers, to be appraised as part of due diligence on the new interest rate trajectory as part of the mortgage loan application, so that you'll know what is their repayment plan based on the current rates and what is the expected rates, especially we know that most of the purchases have been done on the low interest environment for the last couple of years, and it will dramatically change over the next couple of years. Thank you.
Thank the member for his question. I think it's a very important question with regards to particularly first-time home buyers entering the property market at this juncture where potential interest rates can rise. First, I think it's quite important that we will urge all home buyers to exercise caution in their home purchases and in making these decisions, and also in financial prudence of how much they can borrow and their own balance sheets, giving potential rise in interest rates. We also note that even as interest rates increased after an extended period when it was uncharacteristically low, and so we had a whole period where interest rates were just uncharacteristically low over time, household income, as I mentioned in my original answer, are expected to continue to grow alongside the broader economic recovery as we emerge from the pandemic. Second, the member will be pleased to know that Money Sense educates the public on property loan issues through a property resource guide on its website, and social media posts. Issues covered include the importance of buying within one's means and the features of different types of loans. And Money Sense intends to push out more material on the impact of rising interest rates on financial decisions, including on property purchases. Thank you.